Hello, and welcome to this presentation on senior debt financing. In this presentation, we'll be going over what senior debt financing is, what makes it different from other sources of capital, and to finish off, we will summarize what the advantages and disadvantages are of using this type of financing to fund a company. So before we jump into this presentation on senior debt financing, I do want to set some context for our discussion. So a company may require capital for a wide range of purposes, from funding working capital to making investments in things like equipment, real estate, software, research and development. These are just a few examples of the many expenses that a business may have. And if a business doesn't have cash in the bank account to fund all these expenses and investments, then a company will have to turn to an external provider of capital. So a private, small to medium sized enterprise that is looking to raise capital has three main financing options: equity financing, quasi-equity financing, and senior debt financing. So let's begin with the first bullet point, equity financing. So this is the process of raising capital by selling an ownership stake in a company. The equity investors will then earn a return on their capital through their shares growing in value as a company grows in value, and through a potential distribution of profits. The next bullet point down, we have quasi-equity financing. So this is a unique type of financing that has characteristics that make it similar to debt, but it also has characteristics that make it similar to equity. So usually there is a fixed interest payment that is involved, which makes it similar to debt. But there is also a variable component, such as a royalty fee, which is a distribution of profits, or through an equity ownership in a company, which makes it similar to equity. So that's quasi-equity financing. The last bullet point here, we have senior debt financing. So this is capital that is borrowed from a lender and has to be repaid through scheduled principal and interest payments, and is secured by assets in a business. So a private small to medium sized enterprise has three main financing options. But why would a company go with one option versus one of the others? Well, hopefully after we go over this chart, you'll see some of the advantages and disadvantages of each type of financing. So there's a lot happening in this chart, and the best way for us to understand this chart is if we start at the left-hand side of the table. So we have assets listed here, and we have an arrow pointing up. So the arrow is pointing at the provider of capital that has a highest claim on a company's assets. So if a borrower goes bankrupt and is no longer able to make the principal and interest payments on senior debt, a senior lender will take possession of the company's assets, sell those assets, and recoup its capital. So why does this matter? Well, the reason why this matters is because no matter what happens, a senior lender in most cases will get most of their capital back. And as a result, a senior lender is taking on low risk. And risk is directly correlated to the expected return on capital. So senior lenders have a low expected return on capital. Now, quasi-equity lenders have a second lien on a company's assets. So a quasi-equity lender has to wait until a senior lender recoups all their capital before a quasi-equity lender can make a claim on a company's assets. And as a result, a quasi-equity lender is taking on more risk. And the result of that is that the cost of capital is higher. Now, equity investors or capital providers are taking on the most amount of risk. If a company goes bankrupt, an equity capital provider has no recourse on a company's assets. And so an equity investor will receive nothing. And the result of that is that an equity capital provider is taking on a lot of risk, and the expected return on their capital is much higher. So that's the first difference between the three options. Senior debt is the cheapest, equity capital is the most expensive. Another difference between the three are on the repayment terms. So with senior debt, there are scheduled monthly principal and interest payments. These payments must be met no matter what. Now, quasi-equity lenders are a little bit more flexible when it comes to the repayment of their capital. Now, usually there is an interest payment that is involved, but it may not have to be made on a monthly basis. It may have to be made on a semi-annual basis or on an annual basis. And the variable component that is involved with quasi-equity is also flexible in that the royalty fee may only have to be paid once per year, and the shares that a quasi-equity lender receives through the execution of options to purchase equity in a company may not be sold for a number of years. So again, the repayment terms are much more flexible than they are with senior debt. Now, equity investors are the most flexible. So an equity capital provider will won't usually sell their shares for a number of years. This could be 5 or 10 years down the road, and they may not receive a distribution of profits for a number of years. The last difference between the three is on the control side of things. So a senior lender has no control over a business. Management has full discretion on how to run a company. Now, quasi-equity lenders are taking on some more risk, and as a result, they may have a seat on a company's board and may have some influence on a company's direction and future. Now, equity investors are taking on the most amount of risk, and as a result, equity capital providers will most likely have quite a bit of control over management's decisions. Now, the last bullet point here lists some examples of who provides each type of capital. So in the previous slide, we went over the main characteristics of each type of financing. But what are the main advantages of senior debt? So let's begin with the first bullet point. First off, senior debt is the cheapest cost of capital. So in comparison to the two other financing options, senior debt is the cheapest. Secondly, senior debt is tax deductible. So the interest on debt is an expense that is recognized in a company's profit and loss statement. And as a result, at year end, a company will pay less tax. So senior debt acts as a tax shield. Thirdly, management maintains full control of a business. So in most cases, senior lenders have no control over a company, and the shareholders of a business have full discretion on how to run their company. Fourthly, there's no equity dilution. All ownership remains with the shareholders of a company. Senior lenders receive no shares in a company and thus do not participate in the growth and appreciation of a company. All shares remain with the shareholders of a business. Lastly, retaining profits. So after all principal and interest payments are made, senior lenders have no right to the future profits of a business. So in the previous slide, we went over some of the advantages of using senior debt. But what are the disadvantages? So let's begin with the first bullet point, mandatory payments. So senior debt has scheduled repayments of principal and interest. It's a fixed expense that must be met, usually on a monthly basis. And the reason why this is a disadvantage is because some businesses that have unpredictable cash flows may find it difficult meeting the monthly principal and interest payments. The second bullet point down is covenants. So what are covenants? So covenants are an agreement between a business and a lender to not partake in certain activities. Now, covenants aren't always required. They're evaluated on a case-by-case basis. But some examples of covenants include restricting management from acquiring further debt, or making distributions to shareholders, or making acquisitions or investments in capital expenditures. So in some cases, businesses lose control, or management loses control over how they conduct or run a company. The third bullet point down is accessibility. So some companies may find it difficult qualifying for senior debt for two reasons. First off, they have insufficient collateral, which we'll go over in the last bullet point. And secondly, some businesses may not meet the financial performance requirements required to qualify for senior debt. And we'll go into that in greater depth in another presentation. So the last bullet point here, some businesses may not have enough assets to secure debt, which may make it difficult to qualify. And lastly, in some cases, the shareholders of a company will have to sign, or may have to sign, personal guarantees. So the shareholders will be personally liable for the debts of a company if a company goes belly up. So that's it for our presentation on senior debt financing. In summary, if a business has consistent cash flows and profits to make scheduled payments, and enough assets to use as collateral, a business should strongly consider senior debt financing. It's the cheapest cost of capital, results in no equity dilution, and in most cases, shareholders maintain full control of a business. So coming up next, we'll be reviewing how lenders underwrite senior debt. We'll look at what information is required and how lenders complete their financial analysis.